Welcome back to our Finance and Investing Informational channel. Today, we're diving into the exciting world of investing and covering the fundamentals that every beginner should know. By the end of this video, you'll have a solid understanding of stocks, bonds, mutual funds, and ETFs, as well as essential concepts like risk, diversification, and asset allocation. So let's jump right in. Let's begin with stocks. Stocks represent ownership in a company. When you buy a stock, you become a shareholder, which means you have a claim on the company's assets and earnings. Stock prices can fluctuate based on factors like company performance, market conditions, and investor sentiment. Investors often buy stocks with the expectation of capital appreciation or the opportunity to earn dividends, which are a portion of the company's profits distributed to shareholders. Now, let's move on to bonds. Bonds are debt securities issued by governments, municipalities, and corporations. When you buy a bond, you're essentially lending money to the issuer in exchange for regular interest payments and the return of the principal amount at maturity. Bonds are generally considered less risky than stocks because they offer a fixed income stream and are typically backed by the issuer's ability to repay the debt. However, it's important to assess the creditworthiness of the issuer before investing in bonds. Next up, mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They are managed by professional fund managers, who make investment decisions on behalf of the investors. Mutual funds offer individual investors an opportunity to access a diversified portfolio without having to select and manage individual securities. They can be categorized into different types based on their investment objectives, such as growth, value, or income. Finally, let's talk about ETFs, or exchange-traded funds. ETFs are investment funds that trade on stock exchanges, similar to individual stocks. They aim to track the performance of a specific index, sector, or asset class. ETFs provide investors with diversification, flexibility, and transparency. They can be bought and sold throughout the trading day at market prices. Additionally, ETFs often have lower expense ratios compared to mutual funds. Now that we've covered the basics of stocks, bonds, mutual funds, and ETFs, let's discuss some essential concepts that every investor should understand: risk, diversification, and asset allocation. Risk refers to the uncertainty or potential for loss in an investment. Different asset classes have varying levels of risk. Generally, stocks are considered riskier than bonds, but they also offer higher potential returns. Diversification is the practice of spreading your investments across different asset classes, sectors, and geographic regions to reduce risk. By diversifying, you avoid putting all your eggs in one basket and can potentially mitigate the impact of poor performance in one area. Asset allocation is the process of determining the ideal mix of stocks, bonds, and other assets in your portfolio based on your financial goals, risk tolerance, and time horizon. It's important to regularly review and rebalance your portfolio to maintain the desired asset allocation. Thanks for watching.